Hello, this is Trading with Confidence, and I'm John Breland. So today I'm going to talk about support and resistance lines and zones and how traders trade off of them. I'm also going to talk about diagonal support and resistance, pennants, and flags. So let's get started. So now I'd like to talk about probably the most popular way to look at the markets. And it's one of the most popular and one of the most simplest ways. And it's used by a large percentage of traders. And that's with horizontal support and resistance lines. So a horizontal support resistance line is a line that matches up various points in the market at different times. A perfect example would be, we're looking at Bitcoin here. This spot right here is a perfect support line. You see that the market, even though it went past at this point, the market bounced at this level. It moved along and bounced again at this level, bounced again, went up, and now we're approaching that level again. So what makes it a support resistance line, the line that people look at, is when you get these matching areas where the market tends to either bounce from or from underneath or from up above. So another example would be how the market reached this high right here. You can see that later on in time, it bounced off that particular level. It bounced from underneath the level, bounced from underneath and then on top, and then it kind of waddled around in that area for a while. It bounced here, and then now it's waddling around now and possibly coming up back to that level again. So it's simply the most simply stated way to trade the market is off of these levels. So you'll see, for example, that when the price fell right here, there were a lot of trades taken at this bottom. When the price moved down here, it basically hit a wall. The wall existed because this level was already known, and many traders put in their buy orders down here. So as much as the sellers came in, the people selling at the market, they were being hit by all these pre-existing buy orders because they knew that this was a very significant line in the market. So, I mean, you can find these. You just basically have to find a peak and see if it matches with other levels in the past. Like right here, there's a peak. You see that it came to a peak here. Here it bounced it right. That little specific area, this little specific area. You know, when you get to the tops, then it gets a little bit unclear. You know, we had an area right here. Well, this couldn't be considered an area right here. There was a top here, and it bounced off of this top, off of this level. But it's interesting, as the market went up, the levels got a little bit tighter. So these are like well-known, well-established areas. And so you'll hear people talking about the market going to a certain level. You know, they say it'll go to 29.5, or they'll say they'll go to like to 20K. So I mean, this was the level that was created back in 2018, late 17, 18. And so this level got hit here, and it stalled a little bit, and then it went through it. But it's very possible that the market is heading towards this level again, because very often levels that are achieved from the underside get bounced on from the upper side. So this never got bounced on from the upper side. We can see that it almost did, but it was so strong that it pretty much sliced right through it. So it's very likely, in my opinion, that the market could go down, back down to this $20,000 level. So the way that traders generally trade these movements, you can think of it kind of like the market tends to like to snap to these levels, and it doesn't really snap, but as it moves in between the levels, there is a tendency for it to move pretty quickly from level to level. Moves, like this, and then down to this level, and up to this level. So, basically, a trader will take a position at a particular level. Let's say that they think it's going to bounce, and if it does bounce, they keep it until the next level is reached. If it slices through the level, there's a very good chance that once the level is breached, it'll come back to that level and then continue down. So here's an example where, let's say you did a buy right here. Well, the level got breached, so then you would turn around and then sell right here. It indicated it was likely not going to be bouncing off that level, but it was going to go right through it. So often what they'll do is they'll reverse their position and take a short in this area, and that actually turned out to work. So levels are very good to watch, and I think over time, as you get more experience with levels, you'll have a better idea of how to trade them. So sometimes when the market is moving up and up and up, you don't really get a level until there's a first peak. For example, this level was known here, but this level was not known. Right here was not known until a peak appeared. So this level was actually created at this time. This level right here was created when this low appeared. So this came first, this came second, this came third, and so as the market moves, new levels are generated all the time. But typically, once they're created in the past, they tend to stick, and sometimes over time, better levels appear where you get more and more peaks and troughs hitting those levels. Then you can create new levels. But so like the trade in this case right here. So one thing I want to say is that these levels are not necessarily lines, but they're more like ranges. And the reason that they're ranges is because people will take their trades, like for example, here, let me put this level down. So this was like a level area where it hit pretty solidly here, but it didn't hit solidly here. So why didn't it hit solidly here? Well, the reason is because as the market moves down, people don't like to necessarily put their trades exactly at the level. If they want to be sure they're going to get in, they'll put it above the level. And a lot of people are doing that. So what happens is you get a lot more orders just slightly above the level, which then causes the market not to quite hit the level. So that's why you get this. That's why it didn't really hit the line, and why it's better to think of levels as ranges. The level like be a range between here and maybe like there. That. So yeah, that's the general idea about levels. They're not perfect. They don't always hit perfectly. That's why you have to kind of fudge with them a little bit. And nobody hits these things perfectly. Even the top pros, they don't hit it perfectly. So another thing I'd like to talk about regarding levels are diagonal levels. And when you start to draw diagonal levels, you start to see things like flags and pennants. And I'm going to show some examples of that. So as you can see here, we're matching all the highs in this area. Then we're going to match all the lows in this area, like something like that. So, in a bull market, this would be considered a pennant. You move this like this, or like a pennant. And the trade out of a pennant is to take the breakout. So the classical analysis of this is that you get these periods of time where the market is moving kind of like more like moving sideways than any particular direction. In this case, definitely it's down, but the rate of this motion is pretty much in this direction versus the rate of motion of the market is much at a much higher slope. So the downslope is a lot slower than the upslope. And so this is considered like a consolidation period. And in these consolidation periods, there's a lot of pent up energy in them, so that when they break out, they tend to break out pretty hard. And here's a good example of that. But here's another example where you match the highs and then you match the lows. We have this pennant here and breakout occurs. And that's a very good breakout right there. There's another one right here. This is more of a flag than a pennant. It doesn't really come to a point, but there is a breakout that comes out of it. So traders are looking at these diagonal support and resistance zones. So like this would be considered resistance, this would be considered support. And you would basically look for any breakout, whether it's going to break out above or below. So sometimes these don't work out, especially like if you're expecting a bullish breakout. Here's a flag pattern. You could possibly consider this to be a pennant. You do this. So here we had a breakout, but it quickly turned around and continued to go down. These things are used. I should say these are used by a lot of traders to make decisions on how they're going to trade. And if it breaks out in the wrong direction, they're out immediately. It's not a bad way to go, because you can know that the breakouts are pretty violent, and so if it breaks out in one direction and you're in the wrong direction in the trade, you can get out pretty quickly, and you can be pretty safe, knowing that a breakout has occurred. So that's one way to look at diagonal support and resistance. So another thing you can do is you can draw trend lines. And trend lines are like when you match the lows of the market in a large trend. So you can see here the overall trend of this market. You can see that it's pretty much channeling between two parallel lines here. And you see it's at the bottom of the line, it goes near the top of the line, it comes back to the bottom near the top. But you don't really know this line until this starts to move here. So then you can see here what happened, and the market came back down to this line. Some traders assumed this was going to be another bullish move. So the market bounced off this line, went up a little bit, but inevitably, since it was actually a bear market, it crashed right through it. So these work for a time period until they no longer work, basically. So there's something I want to point out about these diagonal lines, and that is, as I mentioned, that the bulls came in here expecting the market to move up, bouncing off of this line. When that did not happen, it was an immediate warning to traders that these lines were no longer in effect, and then that the market was shooting down. And what we got was a very violent shot down when it broke the line. So these lines do have significance to some traders. It's basically like the line in the sand. It says if you pass this line, we're out. So this is one of the reasons why we had a large sell-off at this point. So the lines do have validity. So that's all I have for support and resistance lines. I hope you learned something in this video. If you did, please like and subscribe, and I'll see you in the next video. Thank you. Bye.